The entire SMC industry is built on a multi-million-dollar lie. They took 80-year-old price action concepts, gave them new names like order blocks and fair value gaps, and sold them back to you as hidden knowledge. In this video, I'm going to prove it. I'll show you the original patterns side by side, so you never have to pay for this information again. Market structure stands as one of the purest forms of price reading. Whether you call it price action or smart money concepts, the core stays the same. Price makes higher highs and higher lows in uptrends, lower highs and lower lows in downtrends. In basic price action, you spot a trend by connecting these highs and lows. A possible trend change happens when price breaks this pattern. Smart money concepts named this process differently, but look at the same thing: price breaking its previous rhythm. This chart perfectly shows how price action and smart money concepts describe the same market behaviors with different names. Price moves up, making higher highs and higher lows until a key point where structure breaks. In pure price action terms, you spot a trend by watching how price climbs in a stair-step pattern. Each push-up creates a new high, followed by a smaller pullback that holds above the previous low. Notice how in both sides of the chart, the pattern looks identical. That's because whether you call it trend continuation or break of structure, the price behavior stays the same. The market continues moving higher until it hits a point where the pattern changes. Smart money concept simply gave new names to these classic price patterns. Both methods pay special attention to these structure breaks at key levels. Support and resistance zones matter in both approaches. The market often changes direction at these points, showing shifts in control between buyers and sellers. Where price action traders see a trend reversal, smart money traders spot a change of character. Both describe that moment when price fails to make a new high and instead breaks below a key level. This horizontal line on both sides marks this key turning point. In price action, this represents a support level that, once broken, signals trend reversal. Smart money concepts call the same level a change of character when price shifts direction. Look at how price builds momentum before the reversal. It doesn't just flip instantly. Instead, it forms a series of pushes higher, each one showing less strength than the last. This weakness shows up in both trading approaches. It's just labeled differently. Also, both methods value higher timeframe analysis. Structure on larger timeframes gives context to smaller timeframe moves. So whether you follow price action or smart money concepts, you watch the same price movements. You look for the same shifts in market behavior and trade the same opportunities. Order blocks represent one of the clearest examples of how smart money concepts simply renamed traditional price action patterns. At their core, order blocks mark areas where big market players enter trades with significant volume. In pure price action analysis, traders always watched for strong momentum candles that kicked off major moves. These candles stood out because they showed clear control, either buyers or sellers taking charge with conviction. Smart money concepts just gave these candles a fancier name. The mechanics stay identical. A bearish order block forms when price moves up, then reverses down aggressively. Price action traders always saw this as a supply zone, where sellers overwhelmed buyers. The bullish version shows up when price drops, then reverses up. This is what price action traders call demand zones. Smart money concepts added specific rules about these zones. They say the best order blocks won't see price trade past this candle. But price action traders noticed this too. They just called it a strong reversal level. The market maker angle explains why these zones work. When big players need to fill large orders, they create artificial moves in both directions. They open positions at the order block level, making it a key price zone they'll want to return to later. This matches perfectly with how price action traders always viewed strong reversal candles. They knew these levels often got retested because they marked important market turning points. The smart money framework just explains why these retests happen. In fact, you'll often find order blocks at major market highs and lows. This makes sense in both approaches. These are the zones where big moves start and where trading volume concentrates. Price action traders always watch these areas for potential reversals. The validity rules stay consistent too. Both methods watch how price behaves when it returns to these zones. A true order block, like a strong support or resistance level, should show clear reaction when tested. Market structure plays a key role in both approaches. Order blocks matter more when they break nearby levels. SMC traders value a level that breaks the market structure. At the same time, price action traders always gave more weight to reversal candles that led to new high or lows. Both methods recognize that not all strong candles become important levels. The surrounding market context matters most. An order block, like any price action pattern, needs the right market conditions to work. I hope you understand that price tells the same story, whether you use smart money terms or price action language. Order blocks simply show where big players enter trades. Price action shows strong momentum shifts. Both describe the same market behavior, just with different words. Liquidity sweeps form a basic market pattern that existed long before smart money concepts named them. In SMC terms, you'll know them as liquidity sweeps or liquidity grabs. In price action terms, these are simply false breakouts or bull and bear traps, where price pushes past key levels to trap traders on the wrong side. You'll spot these traps at key market highs and lows. In an uptrend, price shoots below recent lows, triggering stop losses and scaring traders out of good positions. In downtrends, price spikes above recent highs, trapping late buyers before dropping. The mechanics work like this. Big players need to find enough orders to fill their positions. They push price into areas where they know other traders place stops. When these stops trigger, they create instant buying or selling pressure that big players use to enter their positions. Smart money concepts simply added structure to this pattern. They look for liquidity pools, areas with concentrated buy or sell orders. These pools often sit just above resistance or below support, where traders typically place their orders. The validation process follows simple rules. For a bull trap, price breaks above a recent high, then reverses sharply. For a bear trap, price dips below a recent low before bouncing hard. These moves happen fast, catching unprepared traders. You just need to understand how institutional traders use these sweeps. In bullish markets, they need sell-side liquidity below lows to fill their long positions. This fuels the next trend move up. They create these sweeps deliberately to find enough orders. During bearish swings, look for price to pull up to key levels. If no liquidity exists in previous moves, smart money will create it through these sweeps. They build a trap before triggering it. So when trading bullish markets, it's best to place buy orders after a bear trap. You're buying into sell stops, just like big players do. For bearish markets, you sell near recent highs after a bull trap. Whether you call this a false breakout or a liquidity sweep, this concept works because it exploits basic trader psychology. Most traders expect breakouts to continue. When price reverses instead, it forces quick exits that fueled a new move. Smart money concepts just explain the institutional side of this pattern. These sweeps often create decent reversals. Once trapped traders realize their mistake, they rush to exit. This adds momentum to the new move. The key lies in spotting potential sweep zones before they happen. Look for areas where traders might cluster their stops. Price tends to hunt these zones during major market turns. The more obvious the level, the more likely it becomes a target. In smart money concepts, mitigation is just another name for what price traders call retests or pullbacks. It's the process of managing losses or offsetting unfavorable positions when the market moves against the institutional trader's initial entry. Price action traders recognized this behavior but didn't give the institutional context behind it. SMC just gave it a different name and explained how big players adjust their strategies when the market doesn't go as they expected. To begin, let's break down how mitigation works in the context of SMC. Mitigation happens when the market retraces to a level where these institutions can reduce or completely offset their losing positions. For example, price might return to a specific level, allowing them to close their earlier buy trades at break-even or a smaller loss, while simultaneously entering sell positions. Essentially, mitigation allows them to transition from a losing buy position into a profitable sell position in the same price move. Price action traders have always tracked this behavior, though they described it differently. They saw these retracements as pullbacks or retests of previous levels. For example, if price broke below a key support level, price action traders would look for the market to return to that level before continuing downward. They'd call this a retest, where the broken support becomes new resistance. SMC traders, on the other hand, would call this same movement mitigation, especially if they believe it's tied to institutions managing their risk. Mitigation often happens because institutions can't execute their massive orders all at once. Their volume is too large, and doing so would create too much slippage, where the price moves unfavorably as their trades are filled. Instead, they split their orders into smaller chunks. This is why you often see price revisiting key levels before a strong continuation. Take this example. Suppose the market is in a downtrend and price begins retracing higher after a significant drop. This retracement might test the last bearish order block, the last up candle before the sharp move down. Institutions that open sell positions during the drop may have also opened temporary buy positions to hedge against risk. As price retraces to the order block, they mitigate these temporary buy positions, closing them at break-even or a small loss. At the same time, they stack additional sell positions to continue profiting from the downtrend. Price action traders have always observed this behavior in the form of pullbacks to resistance levels or supply zones. For them, these levels represent opportunities to trade in the direction of the trend after a pause or minor correction. Mitigation isn't random. It follows predictable patterns tied to market structure. In a bullish market, institutions may mitigate their sell trades during retracements to key support levels. In a bearish market, they may mitigate their buy trades during pullbacks to key resistance levels. These levels often align with price action concepts like swing highs, swing lows, or supply and demand zones. The concept of mitigation or retest offers a significant advantage. It explains why price often returns to certain levels before continuing its trend. Let's say you're tracking a bearish trend and price breaks below a major support level. Instead of chasing the breakdown, you wait for price to retrace to the broken support. This level now acts as resistance. and the retracement offers an ideal entry point for a continuation trade. SMC traders would call this mitigation, where institutions are offsetting their earlier trades at the retest level. Mitigation also highlights an important truth. Institutions aren't perfect. They don't always get their entries right. Just like retail traders, they deal with losses and use retracements to manage those losses. This understanding helps to demystify the market. Smart money isn't invincible. They face the same challenges as everyone else, but they have the tools and strategies to manage risk effectively. Mitigation can also explain why some retracements go deeper than expected. Institutions may need to push price slightly beyond the obvious level to find enough liquidity to close their earlier trades. For example, if price is retracing to a bearish order block, it might trade slightly above the block before reversing. This deeper retracement occurs because the institutions need to trigger more buy orders to close their earlier sell positions. Price action traders might call this a deep pullback, while SMC traders see it as part of the mitigation process. Inducement is a core principle in smart money concepts, and is what price action traders have long referred to as trap setups. It's the market's way of luring traders into poor positions by creating false moves that look convincing at first, but ultimately work against those who fall for them. While the term inducement might sound like a fresh idea, the behavior it describes has always been visible on price charts. It's just another way of understanding how the market manipulates participants to generate liquidity. As I said before, smart money don't have the luxury of entering and exiting trades like small traders. Their massive trade sizes require liquidity, and they can't execute their positions without triggering significant price movement. Here's where inducement comes into play. Institutions create false moves to attract traders into the market, which generates the liquidity they need to fill their orders. These false moves often appear as breakouts, double tops bottoms, or other familiar patterns that trap retail traders on the wrong side. Take a simple example. Price is trending upward and forms a possible flag formation. Retail traders see this resistance and prepare to go long when price breaks it, expecting the market to continue. Institutions, however, see this as an opportunity. They drive price slightly above the resistance, triggering stop-loss orders from those who were short and enticing breakout buyers to enter the market. After trapping these traders, the market reverses sharply, leaving breakout buyers stuck in losing positions and forcing them to exit. Inducement is often tied to the concept of liquidity pools. These pools represent areas on the chart where stop losses or pending orders cluster. For retail traders, these are the obvious levels, such as previous highs or lows, equal tops or bottoms, or areas of consolidation. Institutions target these zones because they know that triggering the orders in these areas will create liquidity to support their trades. Price action traders have always observed this behavior, describing it as stop hunts or false breakouts. SMC gave it a new name, inducement, but the idea remains the same. Consider double tops and double bottoms, which are classic price action patterns. Retail traders often see these as reversal setups, expecting price to turn around when it retests the same level. But institutions use these patterns to their advantage. They allow price to form what looks like a double top or bottom, attracting traders who base their entries on these setups. Then, they push price slightly beyond the level to trigger stop losses, only to reverse shortly after. This is why double tops and bottoms often fail before eventually playing out. The initial move is an inducement designed to generate liquidity. Breaker blocks are just a refined version of the price action concept of role reversal. They highlight the same behavior of support turning into resistance or resistance turning into support, but with an added focus on liquidity and institutional activity. Price action traders have been using this concept for years, even if they didn't call it a breaker block. In SMC terms, a breaker block is basically a failed order block, causing a shift in market structure and acting as a level of support or resistance for the price. So if price closes below the low of a bullish order block, you can mark that failed order block as a bearish breaker block, which will now act as a resistance for price. If price closes above the high of a bearish order block, you can mark that failed order block as a bullish breaker block, which will now act as a support for price. Price action traders recognized this behavior early on and simply called it support turning into resistance or resistance turning into support. This transition marks a shift in market sentiment. In price action terms, this is called role reversal. When price revisits these levels, it's often a critical moment where big players show their hand, either defending or rejecting the level. You see these flips all the time. Price is in an uptrend and hits a key resistance level. Price consolidates below this level before making a strong breakout above it. Later, when price retraces back to this breakout level, the old resistance now acts as support. Price bounces off this level and continues upward. Smart money traders would call this level a bullish breaker block. These zones often act as magnets for price. Big players use them to manage their trades, either by mitigating earlier positions or by entering new ones. Whether you call it a breaker block or support flip, the principle remains. These levels mark the battleground where institutions make their moves. Breaker blocks also tie into market structure. They are most effective when aligned with the overall trend. For instance, a bullish breaker block in an uptrend has a higher probability of holding than one in a downtrend. A bearish breaker block in a downtrend is more reliable than one in an uptrend. Price action traders have always understood this, prioritizing retests that align with the trend. Fair value gaps are another example of how smart money concepts are derived from price action. In both cases, fair value gaps point to imbalances in the market, where supply and demand are not evenly matched, leading to sharp directional price moves. Price action traders have long observed these imbalances, describing them as gaps or inefficiencies left behind when price moves too quickly to allow for balanced trading at certain levels. SMC formalizes this observation, defining fair value gaps within a clear 3-candle sequence and connecting them to institutional activity. In price action, a fair value gap is identified as a strong imbalance between candles. Specifically, it occurs when price moves sharply, leaving a visible space on the chart, a gap between the first and third candles' wicks in a 3-candle structure. This gap signals that price moved so decisively in one direction that the opposing side of the trade couldn't keep up. This leads to a void or imbalance in the market, which price often revisits at a later time to fill as it seeks equilibrium. Consider a bullish fair value gap. Price starts with a small bullish candle, the first candle in the sequence, then explodes upward with a large bullish candle, the second candle. Finally, a third candle follows, but its lower wick doesn't overlap with the upper wick of the first candle. This creates a gap between the first and third candles, signaling that during the sharp upward move, there wasn't enough selling pressure to counterbalance the buying. Price action traders see this as an area of imbalance, while SMC traders call it a fair value gap. The idea is the same. This gap represents a level that price may return to, either to fill the imbalance or to allow institutions to mitigate earlier positions. A bearish fair value gap works the same way but in the opposite direction. This gap indicates a strong imbalance in favor of sellers, implying that price may revisit this level in the future to restore balance. Fair value gaps often contain what SMC traders call an institutional candle in the 3-candle sequence. In price action terms, these are momentum candles with above-average volume. They represent areas where big players entered the market with significant orders, pushing price sharply in one direction. For example, in a bullish gap, the large bullish candle in the middle of the sequence is the institutional candle. It's the clearest evidence of aggressive buying by big players, which caused the sharp imbalance. In a bearish gap, the large bearish candle in the middle marks where institutions heavily sold, creating the gap. This institutional candle helps traders identify where smart money might re-engage with the market. When price revisits the fair value gap, it often reacts near the institutional candle, either reversing or continuing its previous trend. Price action traders might describe this as price revisiting a key level or a demand or supply zone. When price returns to this zone, big players might step in again to defend their positions, causing price to bounce and resume its trend. For price action traders, this is simply a retracement to a support zone. For SMC traders, it's a revisit to the fair value gap, where institutional activity is likely to take place. This is why fair value gaps act as magnets for price. Whether you call them fair value gaps or imbalances, the idea is the same. These gaps are key zones where price is likely to return. The ICT power of 3 is presented as a unique approach to decoding smart money manipulations. It focuses on 3 distinct phases of price movement: accumulation, manipulation, and distribution. While the concept might seem innovative at first, it is actually a rebranding of the well-established Wyckoff model. The phases of the ICT power of 3 align almost perfectly with those outlined by Richard Wyckoff's methodology, which has been used to analyze market behavior for decades. The first phase is the accumulation. In the ICT framework, this phase represents a period where smart money begin to build their positions without causing noticeable price movement. Price action during this phase typically consolidates, moving sideways in a range. This behavior is no different from Wyckoff's accumulation phase, where large players quietly accumulate assets at lower prices in preparation for an upward move. In the Wyckoff model, the accumulation phase often includes a spring, a sharp downward move that breaks below the established range. This move is designed to trigger stop losses from traders who are long and to encourage others to go short. Once this liquidity is collected, price reverses sharply and begins the markup phase. In the ICT power of 3, this same behavior is labeled as manipulation. The markup phase in Wyckoff's model corresponds to the distribution phase in the ICT power of 3. After institutions have completed their accumulation and manipulated the market to collect liquidity, they begin to push price higher. This is where the real trend unfolds, and price moves decisively in the intended direction. Smart money uses this phase to offload their positions to latecomers who are now chasing the trend. In Wyckoff's terms, this is the markup period, where price climbs steadily as demand outweighs supply. In ICT terminology, this is distribution, where the positions accumulated earlier are sold off into the hands of retail traders who missed the initial move. So both the Wyckoff model and the power of 3 recognize that large players need to manipulate price to generate the liquidity required for their trades. Whether it's labeled as a spring, upthrust, or manipulation, the goal is the same: to trap traders and create the conditions necessary for a significant price move. So no, the power of 3 is not a groundbreaking revelation. It's just a reinterpretation of the Wyckoff model, rebranded with new terminology. Now, price action traders and SMC traders are often seen as two distinct groups with different methods and perspectives. This has led to many debates and even a sense of rivalry between the two. But when you strip away the terminology and look at the core principles, it becomes clear that they're trading the same thing. Both groups are focused on the movement of price, the behavior of market participants, and the effects of supply and demand. Now, if you really want to take your trading to the next level, make sure to check out these next videos